Welcome back to the Daily Crypto Roundup. It's Monday, November 3rd, 2025, and the crypto market has flipped from confident to cautious. The rally that looked ready to carry us into year-end has stalled, risk appetite has faded, and the tone across Bitcoin, Ethereum, and the majors is defensive. You can see it on every chart, and you can feel it in the order books. Bids a little thinner, sellers a little braver. Leverage unwinding where it had quietly built up over the last couple of weeks. Today we're going to make sense of that shift, lay out the real reasons behind the sell-off, and map what matters next so you're not trading blind emotion. Here's what we're covering. First, the big driver behind the red screens. Why macro expectations changed, how that fed straight into crypto, and why forced liquidations amplified the move. Second, the shape of this pullback under the hood. What's happening in altcoins versus Bitcoin, and why some names are bleeding while a few are holding their ground. Third, a significant structural story out of Asia, where Hong Kong has just taken a meaningful step toward deeper liquidity by letting licensed platforms connect to global order books. And last, we'll leave the headline story to the end, where we break down the day's most talked about drop and what it actually means beyond the noise. Before we dig into causes and consequences, let's do the numbers the way we always do them. Bitcoin is trading around $107,000, give or take a quick flash of volatility either side. Ethereum is sitting at $3,630. BNB is hovering around the 1,000 line where it spent most of the session. Solana is down to $167 after outperforming for most of the year. XRP is $2.34. Dogecoin is around 17 cents. Cardano is just shy of 56 cents. Tron is near 29 cents. Avalanche is around $17.50. It's a picture of a broad risk-off day. Majors red, high beta names redder, and not a lot of safe harbor unless you were already sitting in cash. Now, what actually changed? The first part is macro expectations. Coming into this week, the market had leaned toward the idea that central bank policy was set to ease again into December. That expectation had been a quiet tailwind under every risk asset, crypto most of all. Then the language shifted. A senior policymaker made it clear there's no automatic path to another cut without firmer proof that inflation is locked back on target. That single pivot takes the oxygen out of the cheaper money soon trade. The dollar firms up a touch, rates back up a touch, and high volatility assets feel it first. Crypto sits right at the pointy end of that chain. The second part is what happens when a macro wobble hits a market that was comfortably leaning long. Leverage doesn't look like a problem until it is. When prices gap lower into pockets of thin liquidity, long positions get forced out by margin rules and stop losses, and those forced sells push prices to the next pocket. You get that familiar cascade where 10 million in liquidations triggers another 10, and another 10, and suddenly a macro remark that should have been worth 1% is now a 3 or 4% slide with altcoins down twice that. None of this is new. It's the feedback loop that gives crypto its speed on the way up and its sting on the way down. The third part is purely technical. Markets telegraph fatigue before they roll. On every time frame from the 4-hour through the daily, you could see momentum diverging, price grinding higher while relative strength stopped confirming. Key supports that held on the way up turn into magnets on the way down. For Bitcoin, that meant eyes shifted to the $105,000 level. Breaks, retests, rejections. If you reduce the noise, the message is simple. The market needed a reset, and it found an excuse. None of that says crash, it says repricing. There's a difference. A crash is indiscriminate, a scramble for the exits. This is more selective. You can see the separation between assets with stickier demand and assets that were being held on margin for momentum. Toncoin, with a user base anchored in messaging rails, drifts but doesn't buckle. Tron, with its utilitarian position in stablecoin flows, bleeds less than the pack. Meanwhile, the names that ran the hottest when sentiment was easy are the ones handing back the most when sentiment hardens. That's the rhythm of every cycle, and it's playing out again in miniature right now. Let's talk altcoins with a clear head. Solana first. It's the name that defined a lot of this year's upside outside of Bitcoin. It deserved a breather. If you look at the volume profile, today's slide looks like a mix of profit-taking and derivatives unwinding rather than any collapse in belief. The same story appears across the Layer 2 complex around Ethereum. Good projects, real users, real builders, but prices that were priced for perfection. Those come down first when the mood changes, because that's where the leverage hides. Cardano and Dogecoin tell the same story in different ways. One a long horizon builder coin, one a pure sentiment coin. Both are liquid enough to be used as sources of funds when traders need to raise cash in a hurry. On a day like this, they serve that purpose. If you're looking for where the market might try to stabilize, think in terms of behaviors rather than miracle levels. Watch whether downside volume starts to shrink into tests. Selling that can't push new lows is often the first sign that the forced participants are out. Watch whether perpetual funding flips decisively negative and then starts to normalize. Too many shorts chasing a move late can be fuel for the first bounce. And watch whether the strong hands, the people who didn't chase the last leg up, actually start to place bids rather than tweets. When that cohort shows up, floors appear faster than the headlines change. We're going to take a quick break for a quick word from our sponsors. Then we'll be straight back with why analysts are calling this a healthy reset rather than a full-scale crash, and how Hong Kong's new rule change could reshape liquidity across Asia. Welcome back. Let's pick back up where we left off. The headline move today comes from XRP, which slid more than 6% in the past 24 hours, erasing roughly $1.5 billion in market value. The drop pulled prices from around 260 down into the mid-230s. There's no new court twist, no panic from Ripple itself. This was pure market mechanics. Traders who chased the breakout are now taking profits, and the leveraged money that chased too high is being flushed out. Nick Ruck, director at LVRG Research, summed it up perfectly. The Fed's tone scared investors in the short term and erased recent gains. While the Fed cut interest rates as expected, Chair Powell's cautious press conference triggered a sharp sell-off in a classic sell the news event. That's exactly how this played out. A market that had priced in perfection suddenly found itself with no fresh fuel, and the air came out of the trade. Over at BTSE, Chief Operating Officer Jeff May added, "Asset prices are already elevated, and further easing is unlikely unless economic weakness becomes pronounced." In other words, the Fed just told traders to stop expecting a parade of cuts. That one shift tightened risk across every major asset, and crypto, being the highest beta corner of the market, moved first and fastest. For XRP specifically, the battlefield is clear. That 240 support zone is the line in the sand. Hold it, and you've probably seen the worst of the shakeout. Lose it, and the next cluster of bids doesn't come in until around the low $2 zone. On-chain data from Sentiment still shows no abnormal outflows from Ripple wallets, so the fundamentals haven't changed. This is traders repositioning, not believers fleeing. Elsewhere in the market, we're seeing a clear divide between speculative names and utility plays. Toncoin is barely down 1%, encouraged by steady demand from Telegram's payment ecosystem. Tron is holding near 29 cents, supported by consistent stablecoin flow that doesn't dry up when funding turns negative. Those are the quiet indicators of real usage. Tokens that still move value when traders go quiet. On the other side, the fast money layer ones, Solana, Cardano, and Dogecoin, are handing back larger chunks. Solana's down nearly 9%, Cardano around 6%, and Dogecoin roughly 8%. But context matters. Solana's still up almost 400% this year, and Cardano's developer commits remain near all-time highs. What's happening here isn't structural collapse. It's a positioning reset after an overextended run. The most forward-looking story today isn't even about prices. It's what's coming out of Hong Kong. The city's Securities and Futures Commission has confirmed that licensed virtual asset platforms can now share global order books with overseas affiliates. That might sound technical, but it's huge. It means Hong Kong exchanges can finally tap global liquidity without pushing users into gray market platforms. SFC Chief Executive Julia Leung said this integration would enable local investors to access global liquidity efficiently with better price discovery. And Eddie Yue, head of the Hong Kong Monetary Authority, framed it as part of the city's FinTech 2030 plan to turn tokenization into a mainstream financial tool. For traders and funds, that's not just rhetoric. It means deeper order books, tighter spreads, and fewer flash wicks when markets shake. And on days like this, when volatility spikes globally, those changes are the difference between an orderly correction and a liquidity vacuum. So what does all this tell us? It tells us this downturn isn't panic. It's repricing. A clean out of leverage, a macro tone adjustment, and a reminder that crypto has grown mature enough to trade with global policy in mind. If you're trading Bitcoin, the signal to watch now is the first rebound. Strong markets bounce with declining sell volume and build higher lows fast. Weak ones drift back to the breakdown level and hang there. If you're watching Ethereum, keep an eye on activity across the Layer 2 networks. As long as transactions stay high and gas stays manageable, that ecosystem is still humming underneath the red candles. For altcoins, think in categories. Momentum names exaggerate the move both ways. Infrastructure names absorb it. Knowing which camp your holdings sit in is half the game. Back to XRP for one last note. The reason this story hits harder than most is because the community behind it is huge, vocal, and sensitive to price swings. But every cycle reminds us that liquidity always rules. As long as there's volume and a functioning network, the noise fades faster than it feels in the moment. The next few sessions will hinge on three signals. 1. Whether Bitcoin can reclaim and hold above 106,000 with lighter sell volume. 2. Whether Hong Kong exchanges actually start printing bigger trades under the new regime. And 3. Whether altcoin losses start to narrow even as Bitcoin stabilizes. When that pattern shows up, that's the first step back to strength. So take today for what it is, a reminder that markets breathe, that leverage cuts both ways, and that structure, not sentiment, decides who lasts. This isn't a crash, it's a pause between chapters. Drop your thoughts in the comments, follow the show, and as always, we'll see you at the top.